Hi, welcome to Listen2Riches. Today, I'm here to decipher a book titled Angel with the subtitle How to Invest in Technology Startups, Timeless Advice from an Angel Investor Who Turned $100,000 into $100 million for you. At first glance, you might be a bit skeptical about the title, but don't worry. This book isn't about teaching you the secrets of rich people's success. Instead, it aims to take you on a journey into a profession that specializes in making big money: angel investors. Why do we say that angel investors specialize in making big money? That's because they are a group of individuals who invest in startup companies during their earliest stages. This type of investment carries significant risks, but once successful, the returns far surpass more mature and stable investment instruments like bonds, gold, or index funds. For example, if you had invested $1,000 in Apple when it first started in 1976, by 2018, that $1,000 would have turned into around $15.2 billion in wealth. This is the kind of return a successful angel investor can reap. Of course, this scenario is somewhat extreme because, in most cases, angel investors sell their shares in a startup company 3 or 4 years after their initial investment. This is because if the startup aligns with the market, by that time it should have grown to attract mainstream capital, such as going public or being acquired by a large corporation, and no longer requires the assistance of angel investors. From this, we can see what makes angel investors truly unique: their ability to be proactive in the world of capital, seizing opportunities before mainstream capital enters the scene. It's often said that capital is smart, and by following the flow of capital, you can identify the most efficient areas in the market and discern the economic trends. However, for angel investors to succeed, they need to be even smarter than capital itself. They must anticipate what capital anticipates. This kind of anticipation isn't solely based on data and model-driven price predictions like traditional asset classes such as stocks and bonds. Angel investors need to engage their industry instincts, experiential knowledge, and more. Each angel investor has their own secret methods, so to speak. The book we're discussing today aims to unveil one of these representative methods. The author, Jason Calacanis, is one of the most renowned angel investors in Silicon Valley and the first investment scout hired by the top venture capital firm, Sequoia Capital. Before this book was published in July 2017, he had been an angel investor for only 6 years but already held a portfolio worth $150 million. Among his many investment cases, the most famous is Uber, the ride-hailing app. When the author first began angel investing, he decisively invested $25,000 in Uber when it was valued at just $5 million. Later on, Uber experienced astonishing growth, yielding the author a return of over 1,000 times his investment. This investment established his top-tier status in the investment world. In the book, the author meticulously breaks down nearly every crucial aspect of being an angel investor. He not only shares his own experiences and practical knowledge, but also intersperses lesser-known insider stories about today's tech giants during their startup phases. In the following analysis, we will examine how the author transformed from a struggling kid from Brooklyn, USA, into a billionaire angel investor in 3 stages. In the first stage, we will primarily explore how the author accumulated the initial capital to start angel investing. In the second stage, we will discuss how the author penetrated the angel investing circle, building his network of contacts and resources. In the third stage, we will delve into the author's experiences in actual investments, with a focus on the key strategies he employed when selecting investment projects. Alright, let's now dive into the first stage, the starting phase. We all know that to become an angel investor, you need to have capital at your disposal for investments. However, like most young people at the beginning of their careers, the author was just a penniless kid fresh out of school. So, how did he accumulate the initial capital to kickstart his journey as an angel investor? Back then, the author used a two-pronged approach. First, he embarked on his entrepreneurial journey and then began working as a consulting advisor for startup companies. His first entrepreneurial venture was a magazine called Silicon Valley Reporter. With the advent of the internet age, this magazine transformed into an online platform for collecting and disseminating updates about Silicon Valley, eventually being acquired by the prominent firm Dow Jones. This entrepreneurial experience spanned nearly 7 years but didn't bring him substantial wealth. However, during this long period of toil, he amassed a wealth of knowledge, industry connections related to technology startups, and skills in marketing and public relations. It was because of this experience that he was able to later provide advisory services to multiple startup companies. As an advisor, he didn't need to invest money but exchanged knowledge, technical expertise, connections, or reputation for company shares. Before entering the angel investing arena, the author provided consulting services to a total of 6 companies. The first 3 alone yielded him a return of $700,000. Simultaneously, he continued his entrepreneurial endeavors and achieved notable success. For instance, a blog company he co-founded was later acquired by AOL for a substantial sum. During this extended period of entrepreneurship and assisting startups, the author gained a profound understanding of technology startup companies, much like how one develops keen eyes for alchemy in a cauldron. This pre-entry period allowed him to later discern which startup projects could withstand the crucible of the market. However, at this point, the author mentions that if he could go back in time, he would choose a different path, directly entering the angel investing industry. Why? Well, he reveals that in the late 1980s, when he was around 20 years old, he already had substantial exposure to and understanding of the computer field. He was well aware that companies like Microsoft and Cisco would grow into giants in the future. For instance, he realized that the transition from the command line code interface prevalent in the DOS system to Microsoft's Windows system would be a significant leap. DOS, with its command line coding interface, essentially turned computers into a secret club for a select few, while Windows, with its graphical interface and mouse, could make computers as accessible as a fast food restaurant. The author says that if he had invested a few $100s in these companies in the late 1980s, before Microsoft and Cisco went public, he would have made hundreds of thousands of dollars early on, bypassing the convoluted savings journey. While this may sound like hindsight wisdom, the author intends to remind readers not to let the notion of poverty stifle their courage and smother the potential profits that could have been theirs. In his view, it's more worthwhile to save the money spent each month on various TV packages or video memberships and use it for project investments. Even if you only invest $500 in each company, after 5 years, you would have invested in at least a dozen, and perhaps one of them could yield returns of hundreds or even thousands of times your investment. Even if not, this kind of experience can help you accumulate a more direct sense of investment and connect with a variety of entrepreneurs and investment partners. The author also points out that today's young people have a greater advantage in finding projects compared to his time. They don't even need to personally traverse the globe. All they need to do is open their laptop and invest alongside experienced angel investors. This was impossible a decade or so ago, but in recent years, the United States has witnessed the emergence of numerous legitimate organizations specializing in angel group investments. On these platforms, successful angel investors form investment groups. They introduce themselves, typically specifying the industries they invest in, the companies they've already invested in, the amount they usually invest, and the commissions they receive when projects succeed. Young individuals who are just entering the angel investing field can simply register on these platforms and join one or several angel investment groups, allowing them to invest a small sum in each evaluated startup within the group. Furthermore, the author provides some advice on how to choose joint investment projects. He believes that investors should primarily focus on several project characteristics. First and foremost, the leader of the investment group should have at least 5 years of investment experience and have invested in at least one well-known unicorn enterprise. A unicorn is a startup company valued at over $1 billion that has been established for less than 10 years and is not yet publicly traded. Additionally, the startup company should have at least 2 founders to ensure the business can continue running smoothly if one founder exits. Moreover, the startup must have already launched a product or service and not just be in the conceptual stage, among other criteria. According to the author, for novice angel investors, participating in around a dozen joint investment projects before formally entering the industry serves not only to generate financial returns but also as a process of expanding their network and building a reputation. However, after the initial phase, once you have accumulated a certain amount of capital and knowledge, it's time to leave the cozy nest of joint investments because the best projects are generally not publicly listed on these joint investment websites. You must independently screen investment projects and conduct thorough evaluations of companies and meetings with entrepreneurs. According to the author's estimation, an angel investor must evaluate over 10,000 startup projects, meet with thousands of founders, and eventually invest in around 200 projects over the course of 10 years, of which only a few may succeed. This makes the entire process of screening investment projects akin to panning for gold. You need to sift through a lot of sediment and impurities to have a chance of finding real gold. So, how can this be achieved? Well, let's imagine for a moment if you wanted to maximize your success in panning for gold, would the first thing you do be to pick up your tools and start digging right where you are? Probably not. The first thing you would likely do is determine which piece of land has the most gold deposits and then head there to start digging. Angel investing follows a similar principle. You need to seek out projects in the fertile ground where innovation and entrepreneurship thrive because it's here that the next unicorn is most likely to be born. If you're in the United States, the author makes it clear that you must go to Silicon Valley because in the last 50 years, no place has brought more change to the world than this small peninsula. The world's most well-known tech giants such as Google, Facebook, Apple, Twitter, Uber, and LinkedIn were all born in Silicon Valley. The most exceptional and promising tech talents and entrepreneurs often gravitate to Silicon Valley, and if the best entrepreneurs are here, the best angel investors must also be here. So, once you've arrived in the gold-rich land of opportunity, can you roll up your sleeves and start prospecting? Not quite, because relying solely on a newcomer's efforts is not enough to extract those hidden gold deposits. The hottest projects are usually snapped up by seasoned veterans of the startup scene long before you even hear about them. Therefore, you must quickly enter the circle, leverage the information and networks within it, and establish connections to access the most promising gold mines. The author refers to this process as building a project-sharing network. How do you go about it? In the first step, you need to take stock of the co-investors you've worked with in your previous investments in startups and compile their details into an electronic spreadsheet. If you've invested in 10 startup companies through joint investment websites, for example, your spreadsheet will include a potential pool of 500 to 600 investors. The second step involves adding the LinkedIn, Twitter, and Facebook links of these investors to your spreadsheet and then sending them friend requests on these social platforms. Your friend request can go something like this. Hello, Mr. X. I've also invested in Company Y, just like you, which helps establish a sense of proximity. After this, you should open these social platforms daily, interact with and engage these investors, thus distributing social currency. Through this process, you can establish basic social relationships with these industry insiders. The third step is to selectively send emails to those investors who garner the most attention and invite them to meet in person. During these meetings, you can focus on understanding the projects they have recently invested in, why they chose to invest in those projects, and how they have assisted these startup companies. Additionally, don't forget to inquire about any interesting projects they are currently evaluating, and you can also discuss the projects you've recently invested in and see if they are interested in meeting the founders. The author emphasizes that every time you meet with other investors, you must treat it as if you are in a job interview, presenting your best self. In today's society, capital is abundant, but truly excellent projects are scarce. Remember, as we mentioned earlier, the best projects are often funded long before they become widely known. Therefore, you must present yourself well enough to convince experienced angel investors to introduce you to their prized projects. Once this trust gate is opened, you can start accumulating resources continuously and weave a network of project sharing with other investors. When you have your private project flow through the project sharing network, the next step is project selection. First, you need to clarify the industry track you want to invest in, which is the industry where the project is located. In the author's view, there are only two types of industry tracks in the world, those that experience explosive growth and those that don't. Here, explosive growth refers to projects that can achieve a valuation of several $billion with stock values increasing by hundreds of times. The author points out that traditional industries like restaurants, movies, clothing, and wine, except for very rare cases, make it extremely difficult for founders to reach this level of success no matter how hard they work. You might argue that companies like McDonald's, Starbucks, or traditional enterprises like Lululemon in the yoga apparel industry have already achieved gigantic valuations. Yes, but it's essential to note that behind their massive scale lies decades of accumulating power and growth. In reality, most of us can't afford to wait that long to accumulate wealth slowly, and this applies even more so to angel investors. They are looking for companies that can become giants within 5 to 10 years. Information technology companies far outperform traditional enterprises in this regard. Why is that? It's based on a relatively simple economic principle that determines a company's expansion boundaries, which is the marginal revenue and marginal cost associated with each unit of expansion. As long as marginal revenue is greater than marginal cost, a company will continue to expand until they are equal. The fundamental difference between traditional and information technology companies in their expansion lies in how their marginal costs change. Take McDonald's as an example. Their expansion involves selling one more hamburger or opening one more branch, and these costs are nearly fixed. The cost of opening the 9th branch isn't significantly lower than the cost of the 8th. In contrast, companies like Google or Uber, which are software-based, expand by getting more people to use their software. Once the software is developed, the cost of adding one more user is minimal, perhaps requiring a concentrated increase in operational and maintenance investment only when they reach a certain limit. This is why the author advises angel investors to focus on the information technology track rather than traditional ones. Once you're on this track, how should you go about selecting specific projects? The author tells us that what you should focus on isn't the idea or the market, but rather the entrepreneur themselves. People don't represent everything, but they are the only judgment criterion. This is a phrase the author repeatedly emphasizes in his blog. Nobody can know for sure if a company will succeed in the future, but we can assess whether the individuals founding the company have the potential for success. To make this judgment, we need to interview the entrepreneurs. Imagine you have an entrepreneur sitting in front of you right now. How do you determine if they have the potential to create the next Google, Facebook, or Uber? The author provides 4 key questions you can ask them. The first question is, what are you doing? This question may sound like you're asking about what their company does or why you should invest in their company, but fundamentally, these questions are about the what rather than the who. We need to recognize that Google's success wasn't because it was a company that did information search engine, but rather because Google's 2 founders could write software that was superior to their competitors, helping people find information faster. So, if I ask an entrepreneur, what are you doing? It helps focus on the entrepreneur themselves and what they are capable of doing. The second question is, why are you doing this project? Asking this question might yield a variety of answers. Here, the author reveals the two worst types of answers he has heard as an angel investor. The first type is for making money. The author points out that if someone is starting a business solely to make money, they are likely to give up eventually. Think about it. If you have the skills required to develop a top-notch search engine, you could easily get hired by Google or Facebook, earning a direct income of $1 million a year through stock and salary. In that case, why would you take on substantial risks, investing significant time and effort in independently developing software? In summary, if the motivation for entrepreneurship is purely about making money, entrepreneurs often realize that there are quicker and more profitable ways to make money than through entrepreneurship in the short term. Consequently, they lose interest in the long-term commitment required by entrepreneurship. The first category of bad answers has been discussed above, and the second category of bad answers involves adding a feature to an already successful company. For example, after the author invested in Uber, he frequently received recommendations for an Uber-like service that delivers food, shares helicopters, or is used for shopping. The author believes that such entrepreneurs often lack foresight because they choose to develop a complementary feature for another company's product rather than creating a complete product or having a grand mission. Such companies, even if they succeed initially, are usually squeezed out by large companies or acquired cheaply, missing the chance to become a unicorn. Having discussed the two categories of poor answers, how should you answer the question, "Why are you doing this project?" The author tells us it varies from person to person. For example, if you were to ask the two founders of Uber, they would tell you that their initial motivation for starting the business was simply because they couldn't find a taxi in Paris when attending a tech conference. Facebook's founder, Mark Zuckerberg, would tell you that his motivation stemmed from social anxiety. He wasn't good at interacting with the opposite sex, couldn't bring himself to contact his ex-girlfriend, and wanted to create a social platform where he could learn about everyone's interpersonal relationships. This might sound somewhat simple or naive, but when you think about it more closely, is there anything more critical in the world than reproduction? According to Darwin and Freud's theories, there isn't. Therefore, Zuckerberg's social anxiety ultimately led to the fastest-growing consumer product in human history. The third question is, why now? According to the author, in some ways, this is the most important question because there are always many people attempting the same ideas in the field of innovation and technology. When we look at many internet giants today, we might have the feeling that they succeeded because they were the first to dominate a particular track. However, what many people may not know is that Facebook was the 10th social platform, Google was the 12th search engine, the iPad was the 20th tablet, and YouTube, to count, was one of many video websites. They were not the earliest players in their respective tracks. But why did they become the fastest and the best? Here, the author tells us that it's not about who does it first, it's about who does it first when the conditions are right. What does that mean? Let's go back to the example of Uber. In fact, before Uber, another startup attempted to help people book taxis through their phones, and their answer to the why now question was SMS, short message service. However, SMS was far from sufficient to support the development of a mobile ride-hailing business. This type of business required smartphones with high-performance central processors, intuitive large touchscreens, and military-grade GPS accuracy, and these were precisely Uber's answers to the why now question. Now let's take a look at YouTube. Before YouTube appeared, there were actually dozens of video websites. However, at the time, due to high broadband and network storage costs, if a video you posted on the internet went viral, you would have to pay tens of thousands of dollars in server fees to the video hosting websites. But when the era of YouTube arrived, the bursting of the dot-com bubble led to reduced broadband costs, and the emergence of cloud computing resulted in lower network storage costs. This allowed YouTube to not only stop charging video creators but also share advertising revenue from popular videos with the creators. This gave birth to a vast amount of high-quality user-generated content and powered its rapid rise. In essence, it's not just about being first, it's about being first when the right conditions align, enabling a breakthrough. The fourth question is, what special advantages do you have? To put it more bluntly, why do you believe you can do this project, or what advantages do you have compared to the fierce competitors and followers? A somewhat sad reality is that many interviews come to an end with this question because many entrepreneurs can't provide a satisfactory answer when faced with it. However, we must recognize that from a practical standpoint, if a founder possesses certain unique advantages, their startup is more likely to achieve tremendous success in the future. For example, Google's two founders had studied at Stanford University and knew many brilliant programmers skilled in algorithms. When Facebook launched, Mark Zuckerberg was studying at Harvard University, and he and his friends were familiar with campus culture, which allowed them to understand the potential market for an online social platform. Another example is Bill Gates' mother, Mary Gates, who served as the executive director of the United Way and had IBM's CEO as one of the board members. This connection gave Microsoft an opportunity to develop an operating system for IBM's first-generation personal computers. So, if someone lacks special advantages in terms of family background, education, or personal skills, does it mean they cannot succeed in entrepreneurship? Of course not. However, the author reminds us that the task of angel investors is not to nurture dreams or act on love alone, but to sift through the turbulent and complex sea of projects to find the one with the highest probability of becoming a unicorn. After asking the 4 questions mentioned above, we have a general understanding of what this person wants to do, what they can do, and why they want to do it. If you feel that they have passed this initial evaluation, you can dive deeper and inquire about the specific tactical details of their entrepreneurship, including their business model, market strategy, team composition, and more. The above points represent the key content I wanted to share with you from this book. Besides these, the book also includes some specific processes, operational details, and a checklist of questions that an angel investor might find useful when assessing projects and founders. If you are interested, you can click on the link at the end of the manuscript to read the original ebook for further insights. Considering the theme of this book, its greatest value seems to be providing a guide for those who aspire to become angel investors or seek the favor of angel investors. However, even if we are not particularly interested in amassing wealth, understanding and learning this angel investment methodology is still highly valuable. Although we may never become angel investors in our lifetimes and evaluate whether someone will become the next Zuckerberg or a company the next Facebook, each of us will at least evaluate a startup project, our own lives. For example, how to find a more promising destination for our capital in the form of time, labor, and more, whether it's a bed in a big city or a house in our hometown. How to judge the expansion potential of a company or an industry. If something fails, is it because the idea itself doesn't work, or is it due to the individuals executing it or external circumstances? Thus, fundamentally, this is a book that teaches us about decision-making and judgment. The author uses his own experiences to tell us that astute decision-making is more important than inefficient diligence, and correct judgment is more valuable than a wealthy background. In the book, there's a passage that compares entrepreneurship or angel investing to being placed in a large, pitch-dark sports arena with a single light switch. You grope around in the darkness, not knowing what you're doing, until you find that small switch and press it lightly, suddenly illuminating everything in front of you. Congratulations on finishing another book. Thank you for your support and attention. Please subscribe to the channel, like this video, and share this valuable knowledge with your friends. Let's combine wisdom with practice to achieve our financial goals and create a brighter future. Thank you all. See you in the next episode.